Hi everyone and welcome to chapter 2. So we are going to determine the cost of capital. So mostly this chapter deals with calculating the weighted average cost of capital. So let's start. So chapter outline, we are going to discuss the first look at weighted average cost of capital. We are going to discuss cost of debt and equity. We are going to have a different look at weighted average cost of capital. We'll use WACC to value a project, project based cost of capital. Raising external capital is costly, so how to deal with that. So learning objectives: understand the drivers of firm's overall cost of capital, measure the cost of debt, preferred stock and common stock, compute a firm's overall or weighted average cost of capital, apply the weighted average cost of capital to value projects, adjust the cost of capital for risk associated with project, and account for direct cost of raising capital. So a firm's capital structure, what is capital? Capital is money that is raised from outside. Money that is raised from outside. So outside means money can be raised from debt, it can be raised from equity, or it can be raised from other securities. Other securities like preferred stocks, right? Capital structure is relative weights of debt, equity and other securities that the firm has in its capital structure. The opportunity cost and overall cost of capital, the weighted average and overall cost. So important thing is weighted average cost of capital. So if you look at the formula for weighted average cost of capital, weighted average cost of capital, WACC. So formula for WACC is weight of equity into cost of equity plus weight of preferred stock into cost of preferred stock plus weight of debt into cost of debt. So we have to find out what is the weight of equity in capital structure for a company, what is the weight of preferred stock in the capital structure of the company, and what is the weight of debt in capital structure. After we find out weights, we have to find out cost of equity, cost of equity, cost of debt, cost of preferred first, and cost of debt. So one way to find out cost of equity is using the CAPM model. So what does CAPM model suggest? CAPM model means the cost of equity is risk-free rate plus beta times return on market minus risk-free. Risk-free rate into plus beta times return on market minus risk-free. Cost of preferred stock is dividend that you received on preferred stock. So dividend received divided by preference stock price. And cost of debt. Now the change between debt is interest is an tax deductible expense. So cost of debt is generally yield into 1 minus tax. Cost of yield is generally yield into 1 minus tax. Okay. So we know cost of equity, cost of preferred stocks, and cost of debt. So once you have cost, you put it in this formula to calculate weighted average cost of capital. So weighted average cost of capital is market value of debt plus market value of equity plus market value of preferred. And if you look at it on a balance sheet, this is left hand side. Equity, debt and preferred comes on left hand side. On the right hand side, it is assets. So that is equal to market value of assets. So weighted average cost of capital can be leveraged or can be unleveraged. Unleveraged means the firm does not have any debt. So that is called as an unlevered firm. If a firm has debt, then it is called as a levered firm. So weighted average cost of capital for unlevered firm that doesn't have any debt is cost of equity. Weighted average cost of capital for a levered firm is weight of equity into cost of equity plus weight of debt into cost of debt equals to assets, right? So they have given an example. Suppose Great Lakes Corporation has a debt with face value of 10 million trading at 95% of face value. It also has book value of equity of 10 million and 1 million shares of common stock trading at $30 per share. What weight should Great Lakes use while calculating? Now when you're looking at weights, the weights should always be market value. The weights that we considered should always be market value. Now what is given? The face value of debt is given. Okay, face value is 10 million. Okay, face value is 10 million and market value is given. Market value is 95% of face value. So 9.5 million. Same way, equity, face value or book value is given, which is 10 million, and market value is given. Market value is $30 share into 1 million. That is 30 million. So which weights do we use? We look at market values. So if you look at that, we are only going to consider market values. We are not going to consider face values. So total market value equals to 30 million plus 9.5 million, 39 million. So weight of debt equals to 9.5 million, right? Market value of debt divided by total market value. So 24% is the weight of debt. Same way, weight of equity is 30 million divided by 39.5 million. So 75% is 76% almost is weight of equity. So important point, we always use market value. Find the market value of debt, find the market value of equity, find the total market value, right? Weight of debt is debt portion divided by total. Weight of equity is equity portion divided by total. The equation tells us that weights are fractions of Great Lakes finance with debt and equity. Furthermore, these weights should be based on market values because the cost of capital is based on investors' current assessment of value, not the assessment of accounting book value. As a consequence, we ignore the book value. So same way, 9.5 divided by 39.5, 25% in debt and almost 76% in equity. When calculating the overall cost of capital, the Great Lakes will use weighted average cost of 24 and 24.1 and 75.9, not the book values. The weighted average cost of capital, the average of firm's equity and debt cost of capital weighted by fractions of firm's value correspond to equity and debt respectively. So weighted average means calculate the weights, calculate the cost, multiply and add. Unlevered firm, a firm that does not have any debt. Levered firm that has debt. Cost of debt, we have discussed it. So yield to maturity and cost of debt. The yield to maturity is yield that the investor demand to hold the debt, new or existing. And since debt is a tax deductible expense, so effective cost of debt is yield into 1 minus tax rate. Effective cost of debt is yield into 1 minus tax rate. So they have given an example. By using the yield to maturity on BCE's debt, we found out that pre-tax cost of debt is 3.14%. If tax rate is 20%, what is the effective debt? So how to do that? So cost of debt equals to yield. I'll write down the formula, yield into one minus tax. Yield into 1 minus tax. Now what is yield? 3.14%. into 1 minus tax. 1 minus tax is 20%. So 2.5% is 2.51% is the cost of debt. So this is given. So 3% into 1 minus 20%, 2.51%. So for every $1,000 it borrows, it pays bondholders 3.14 in interest. Because it can deduct 31 in interest from its income, every dollar it saves 20 cents in taxes. So effective cost is, so it saves $6 in taxes. So effective cost is 25.12 or 2.51%. So why do we deduct taxes from debt? Because debt is a tax deductible expense. Cost of preferred stock, it is preferred dividend divided by preferred stock price. So assume preferred stock has a price of 20.8 and an annual dividend of 1.35. Its cost of preferred stock is 1.3025 divided by 20.8. So find out the dividend, find out the price of preferred stocks, divide them up. That is cost of preferred. Now cost of common shares. So we can either use CAPM model, which is mostly followed. So in CAPM model estimates the firm's beta by regressing 60 months of returns against 60 months of index returns, determine the risk-free rate, right, by using yield on treasury bills or bonds. Generally bonds are used because financing that the company seeks is generally long term. So bonds are used rather than bills. Okay. And then we use formula cost of equity equals to risk-free rate plus equity beta into market risk premium. Risk-free rate plus equity beta into market risk premium. Market risk premium is return on market RM minus RF. So they have given an example. Assume the equity beta of BC is 0.75, 10-year bond yield is 2.35. You estimate the market risk premium to be 6%. So the cost of equity will be 2.35 risk-free rate plus beta 0.75 into risk premium 6%. So it comes to 6.85%. Other way to find out cost of equity is the dividend constant growth model that we discussed in equity. So it is dividend that you will receive in 1 year divided by current price, that is the forward dividend yield plus growth rate. So one other way to find out cost of equity is D1 divided by price, the current price, plus G, growth rate in dividend. So you can either use this formula or this formula. Mostly this one is used. Okay. So dividend divided by price plus growth rate. So in early 2018, the forecast of BCE's long-term earning growth was 3.5%. Thus, with an expected dividend in 1 year of 3.02 and price of 53, the long-run dividend is given as 3. Find out the cost of equity. Cost of equity is dividend divided by price plus long-term growth rate. Okay, so it comes to 9.125%. 9.12%. Same way they are doing one more. Assume the equity beta of TELUS is 0.78. The yield on 10-year bond is 2%. You estimate the market risk premium to be 6%. Further, it pays a dividend of $2. Its current stock price is 46. You expect dividend to increase at constant rate of 4%. Cost of equity in both ways. So there are two ways, CAPM model and growth model. So let's look at CAPM model first. So risk-free rate is given, equity beta is given, market risk premium is given, current price is given, expected growth is given, and 4% is the future growth. So CAPM, risk-free rate plus beta into market risk. So for TELUS, this implies as 2% plus 0.78 into 6%, that is 6.7. And constant growth rate is dividend in 1 year divided by current price plus dividend growth rate. So current dividend is $2. So expected growth dividend will be $2 growing at 4%. Okay. So it is expected dividend is 2.1. So it is 2.1 divided by current stock price 46.5 plus long-term growth rate 4%, that comes to 8.5. So according to CAPM, the cost of equity is 6.7. According to growth model, the cost of equity is 8.6. Because of different assumptions we make when we are using each method, the two methods do not produce the same answer. In fact, it would be highly unlikely that they would. When the two approaches produce different answer, we must examine the assumptions we made for each and decide which is more realistic. We can also see that assumptions about future dividend would be necessary to make the answers converge. By rearranging the growth model and using cost of equity we estimated in CAPM, we have dividend growth rate we can find out should be 2.2%. Thus, if we believe that TELUS dividends will grow at rate of 2.2% per year, the two approaches would have the same answer. Okay. But bottom line, CAPM is used more than the growth model, because CAPM you have the risk measures beta and you are measuring the cost of equity as a function of risk rather than function of growth in dividend. So that's a better approach when you're valuing projects. So the WACC function becomes cost of equity into weight of equity, but cost of preference into weight of preference, but plus return on D yield into 1 minus tax into weight of debt. If the company doesn't have preferred stocks, remove this preferred part. So in early 2018, the market value of BCE's common stock, preferred stock and debt were 48 million, 3.3 million and 19 million respectively. The current value therefore was 70 million. Given the cost of common stock, preferred stock and debt which we have already computed, you can put it in formula. 48 million of equity divided by total 70 million. Oh, it rebooted. So we were at this slide. So 48 million of equity divided by 70 million, that is weight of equity. Weight of debt 3.3 million divided by 70 million, 19 million divided by 70 million. So you know cost of equity, cost of preferred and cost of weight of equity, weight of preferred and weight of debt. Then you just put cost of equity that we have found 3.85, cost of preferred 4.96 and yield into 1 minus tax, that is cost of debt. So WACC becomes 5.58. The expected return on target's equity is 11.5. The firm has yield to maturity of 6%. Debt accounts 18% and equity accounts 82%. If tax rate is 35, what is WACC? So let's do this. So what is given? Given things for you. Cost of equity is given 11.5 directly. Yield is given. Yield is 6%. Then weight of equity is given. Weight of equity is 82% and weight of debt is given. Debt is 18%. Also tax rate is given of 35%. Now to calculate WACC, WACC is what? Preference share is not there, so WACC becomes weight of equity into cost of equity plus weight of debt into cost of debt. Now we need cost of debt, we have cost of equity, we have weight of equity, we have weight of debt, we do not have cost of debt. So we can find out cost of debt. Cost of debt is always yield into 1 minus tax. Tax rate is 35%. So 1 minus 35%. So cost of debt is 3.9%. Now if we put it in formula, cost of equity 82% into, sorry, weight of equity 82% into cost of equity 11.5 plus weight of debt 18% into cost of debt 3.9. So it comes to 10.132. So they have computed it. So 10.1 is the answer. Even though we cannot observe the expected return of target investments directly, we can use expected returns of equity and debt and WACC formula to estimate it. Target needs to earn at least 10.1% on its investment in current and new stores to satisfy equity and bondholders. Now methods in practice. So this was theoretically, right? In practice, we do not use total debt, we use net debt. So total debt, we use enterprise value as the denominator, not the total cap, and we use net debt. Now, if you remember, enterprise value is nothing but market value of stock plus market value of debt minus cash. This is enterprise value. So how do we use enterprise value to calculate WACC? So in real life, WACC is calculated as weight market value of equity divided by enterprise value EV. This is weight of equity. Okay, we find that first. Then we use net debt. Net debt means debt minus cash and divided by enterprise value to get weight of debt. Okay, and we find out WACC using cost of debt, cost of equity times weight of equity that we calculated here plus yield into 1 minus tax, you always have to do that, times WD that we found out here. So this is how you do it in real life, not by using these functions, because cash, whatever you have, you can always use it to pay off debt. So you don't have to consider cash. Okay, so that's why we consider net debt. So methods in practice, the risk-free rate, most firms use yields on long-term treasury bonds instead of T-bills. Market risk premium, so TSX composite is used if you're considering Canadian stock, or S&P 500 is used if you're considering American stocks. Leverage returns and the value of market risk premium has been around 5.88% against risk-free rate of T-bills. Leverage value, the value of an investment including the benefits of interest tax deduction given the firm's leverage policy. WACC method, discounting future incremental cash flows using the firm's WACC, which produces leverage value of project. So leverage value is nothing but the net present value of a firm, which is whatever free cash flows it is going to generate in future, discounted by weighted average cost of capital. So let's see how to do it. Suppose Big Rock Brewery is considering introducing a new ultralight beer with 0 calories called as Big Zero. The firm believes that beer's value and appeal to calorie conscious drinkers will make it a success. The cost of bringing the beer to market is 200 million, but Big Rock expects first year incremental free cash flow to be 10 million and grow at 3% thereafter. So if Big Rock WACC is 5.7%, should it go ahead? Now it is a constant model where it is growing at 3%. So how to find it out? So value today is nothing but free cash flow, right, divided by WACC, weighted average cost of capital, minus growth rate. So this is Gordon's growth model that we discussed. So free cash flow is 10 million divided by WACC is 5.7 and growth rate is 3%. So 370 million is the value today. Now to generate this, the cost is 270 or cost is 200 million. So net present value, the benefit from the project, is present value of benefits minus present value of cost. So it is 170 million. So that is what they have done. 10 million divided by 5.7% minus 3% and subtract that by 200. Okay. The Big Zero project has a positive NPV because it is expected to generate a return of 200 million, far in excess of Rockbrew's WACC of 5.7. As discussed in chapter 8, taking positive NPV projects add values to the firm. Hence, we will continue with the project. Now, key assumptions that we are making. Average risk, we assume initially that market risk of the project is equivalent to average risk on firm's investment. But sometimes that may not be true. Certain projects may be more risky for a firm than the average risk that the firm is carrying. Okay. Constant debt to equity ratio. We assume that firms adjust its leverage continuously to maintain a constant debt. So we are also making an assumption that weights are constant, right? So whatever new projects it is financing, it is using the same weights to finance the project. But that may not be true. If debt is cheaper, firms generally go for debt rather than issuing equity. Limited leverage effect. We assume initially that main effect on leverage on valuation follows from interest rate deductions, that any other factors are not significant at debt chosen. The WACC method application, extending the life of BCE facilities. Suppose BCE is considering an investment that would extend the life of one facilities by 4 years. The project would have a cost of 6.67 million plus a 24 million investment in equipment. The equipment will be obsolete in 4 years and will be depreciated at a straight line. During the first 4 years, it expects annual sales of 60 million per year from this facility. Material cost and operating expenses are given. BCE expects no working capital requirement for the project and it pays a tax of 20%. So what we can do is, like, we use the format that we discussed, right? The free cash flow format. We find out the free cash flows and we discount it by weighted average cost of capital to find out the net present value of benefits. You subtract it from cost, it gives you NPV. Summary of WACC method. Determine the incremental free cash flow of investment, compute the weighted average cost, compute the value of investment including tax benefit of leverage by discounting the incremental free cash flow of investment using WACC. Cost of capital of new acquisition. Suppose BCE wants to enter a discount retail business. To do so, it is considering acquiring Canadian Tires, a company that offers a range of retail goods and services at low cost prices. CTC faces different market risk than BCE does. So, okay. So if a firm is going into different line of business, then so BCE is Bell Communications. So it is mostly into cell service. But if it wants to go into retail and it is acquiring Canadian Tires, then that's a different set of business. So you cannot use your existing WACC for funding that project. So you have to find out WACC that Canadian Tire uses. Okay, because it's a different line of business. Because the risks are different, BC's WACC would be inappropriate for valuing CTC, Canadian Tires. Instead, BCE should calculate and use CTC's Canadian Tires WACC of 5.5% when accessing the acquisition. Now assume BCE decides to create its own discount retail internally, then rather than buying Canadian Tires, then you have to find out right, WACC structure for Canadian Tires and use that for valuing internal creations. Next, you're working for TELUS Corporation, evaluating the possibility of entering electronics manufacturing business. TELUS's WACC is 5.3%. The electronics would be a new line of business for TELUS. However, so the systematic risk of business would probably differ from systematic risk of current business. As a result, this new business should have a different cost of capital. So whenever a company is starting new line of business, we should calculate the WACC for that new line of business and use it. You first need to find the cost of capital for electronics manufacturing business, assuming that risk-free rate is 2% and market cap is 5%. You can estimate the cost of capital. The first step is to identify a company's operating TELUS targeted line. So Shopify operates in e-commerce space. So find out the WACC for Shopify and use it when you're starting a new project. Many websites are available that provide betas for traded stocks, including Yahoo Finance. So we can find out Shopify has a beta of 1.63. With this beta, the risk-free rate and market premium, you can calculate, use CAPM to estimate the cost of equity. Fortunately for us, Shopify has no debt, so cost of equity is same as WACC. So cost of equity for Shopify, risk-free rate of 2% plus beta into market risk premium. So 11.8 is the cost of capital for Shopify. So TELUS's new e-commerce business has a project available IRR of 8%. So TELUS would reject the project because it is less than WACC. Any project that produces less than WACC is rejected. Any project that produces more than WACC is accepted. Had TELUS used 5.3% of cost of capital, that would be a wrong way to do it because it's a new line of business. Issuing new equity or bond carries a number of costs. So there are issuing costs involved when you issue stocks or bonds. So you have to factor that in. They can be incorporated as additional cost in NPV analysis. So they have given an example for that. You are analyzing BCE's potential acquisition of Canadian Tires. BCE, Bell Communications, plans to offer $9 billion as a purchase price for Canadian Tires and will need to issue additional debt and equity to finance. The cost of issuance is $350 million, right? You also estimate that incremental free cash flows will be $400 million in first year and will grow at 1.5 years thereafter. NPV. So we know the WACC, 5.5% is Bell's WACC. We already calculated that. So we can calculate. So 400 million or 0.4 billion divided by R minus G. So where R is 5.5% and growth rate is 1.5. So NPV comes out to be 0, whatever it comes out to be, right? Cost of financing is $9 billion and also 350 million. That is cost of issuing. So you have to also include that. So if you solve this equation, it comes to 650 million. It is not necessary to try and adjust CTC's WACC for issuance of cost of debt and equity. Instead, we can subtract the issuance cost of NPV of acquisition to confirm the acquisition remains a positive NPV project. Okay. So that's it. See you in the next chapter.